China is crumbling. Protests are spreading against the banks. People are getting sick of the government's incompetence. The CCP is so afraid that it has brought out tanks to maintain stability. 2022 is not being kind to the Chinese economy. We are just halfway through the year, but the Chinese economy is already burning and crashing on various levels. What once seemed to be a composed country with everything in order is beginning to show its vulnerabilities as nothing more than a crumbling house of cards. A nation built on pillars of sand. Initial GDP growth projections for the nation have been revised to 4.3% in 2022, almost 1% less than the last projections from December. The question becomes, as the world's second largest economy, the largest by some measures, starts tumbling down, what does that mean for the rest of the world? Or better yet, in what is already a trying year for the markets, what does China's economic collapse mean for you and your financial interests? Let's answer all that in today's video, which is sponsored by Masterworks. More on them later. This is the video I made a few months ago, detailing just how bad China's economic situation was then. I highly recommend you check it out to get a comprehensive picture, but here's a quick recap on the matter. Multiple pillars of China's economy are all crumbling at the same time, and this is having an exhausting effect on the economy. With GDP projections continually shrinking and severe outrage at home, it's hard to see a way out for the Asian giant. Since I made that video, several of these issues have grown in magnitude. And not just that, but new problems have arisen for China. Problems that have far-reaching effects with the potential to affect your finances in America, and investments all over the globe in general. Let's take a look at these factors. Covering China is always a risky move on YouTube, especially when it comes to showing protests. My last two videos were demonetized because YouTube deemed it controversial. On top of that, the CCP is notorious for sending its bots to dislike any videos that are critical of China. Fortunately, you guys have shown insane support over my last two videos. So, I have the same request again. If you guys can just scroll down real quick and hit that like button, it helps me out tremendously.
China's in chaos right now, apparently, in terms of slowing economic growth.
The entire real estate market in China is a disaster waiting to happen.
To China now, where home buyers, furious at the delayed completion of their properties that they're already paying for, have taken things into their own hands.
Imagine a first world country getting to a point where real estate development companies are becoming so desperate that they institute a barter trade system to sell homes. This is the case with a few real estate developers in the eastern provinces of China. To stimulate sales of properties in the face of what is predicted to be a 25% decline in property sales, the developers are now accepting payments in watermelon, garlic, and sometimes even peaches. Yeah, you heard me right. Down payments for apartments and houses can now be made with produce. This, if nothing else, summarizes the desperation that is China's economic situation. You see, China's real estate market is in a slump that was kicked off last year by Evergrande's debt default. Over-indebted developers have since been reined in through the red line policies, which have tightened leverage requirements, but this hasn't really solved the entire problem. Since Evergrande, other property developers, including Shinmao and Sunac China Holdings, have also missed debt repayment deadlines. This sign of overbearing debt is now threatening to topple down the industry, which is responsible for almost 30% of China's entire GDP. Ugh, imagine that. To shore up the sector, regulators recently reduced the loan market quoted rate. In addition, local governments have been advised to implement their real estate policies according to their needs. For example, some local governments, such as Shanghai, have reduced purchase restrictions on homebuyers. Both Tier 1 cities, such as Beijing and Shanghai, and Tier 2 cities such as Suzhou and Jiangsu, have lowered mortgage rates. These local government policies have frequently been used to boost or dampen real estate activity. Although these measures will ease some major indicators, such as property sales and prices, these rules do not necessarily resolve the issues faced by over-indebted developers. They're just throwing buckets of water onto a wildfire. Many developers are struggling to repay their debts amid COVID-19 lockdowns and dwindling demand. These measures also fail to address the underlying issues behind excessive property development. That is why the real estate sector in China keeps getting worse, with new developments making things more unbearable.
The crisis that began with Evergrande real estate defaulting last year is now snowballing into a bigger crisis.
You know, one by one, we have seen these pillars of China's property cycle crumble.
Not only are home buyers refusing to pay their mortgages, developers' bonds are plummeting.
After the Evergrande fears slipped into the market along with the troubles that developers are facing due to too much debt, angry home buyers have begun threatening to stop their mortgage payments on unfinished projects. This movement, which gained traction on social media, is now developing quite the following, enough for Beijing to take notice of it. In China, more than 85% of Chinese houses are sold through pre-sale, up from about 50% in 2005. Mortgages begin months or even years before buildings are finished. However, as projects have slowed since 2020 due to the COVID pandemic, along with liquidity issues that have soon followed, it seems that developers won't be able to honor their agreements, and thus the mobs are amassing. As homeowners continue to refuse to pay mortgages for unfinished projects, the movement keeps growing larger, with what was once a list that started with just 30 projects growing to more than 300 at present. The danger in this lies in that the movement against the pre-sale system puts as much as $350 billion in payments at risk. If all these people default, you can expect a scenario that is far worse than the Evergrande crisis to arise. Chinese authorities are aware of this wildfire danger and have already moved to censor it in a bid to prevent havoc, but the movement is gaining traction very quickly as it feeds on itself in a circle. As developers' cash flow dries up, even more projects are being suspended, which then validates the worries and leaves more consumers angry and fearful that they may never be finished. The longer this cycle goes on, the more trouble China's real estate market gets into. Now, think of this. If property in general makes up 30% of China's GDP, how catastrophic will the damage be if the people start defaulting on payments? And if the Evergrande crisis was enough to have effects that even hit the American markets, what kind of potential does this Chinese crisis have in affecting your financial investments? Because finding alpha is already harder than ever, inflation is rampant, and the recession is already here, this crisis could lead to the perfect storm for your portfolio. Which is why one alternative with minimal correlation to equities is rapidly gaining traction. Typically, only institutions and the ultra-wealthy had access, but one fintech platform called Masterworks is revolutionizing the market. Despite the S&P hurtling into the red, their portfolio's track record is a remarkable 15.3%, showing a low correlation inflation hedge at work. What is this asset? Blue-chip contemporary art. The New York Times says, when the stock market takes a dive, people look to invest in art. Which is why, even through 2022's turbulent markets, Masterworks is still generating consistent returns, with their investors seeing an average net return of 26.8% since 2019. With results like that, the demand for Masterworks is sky high and there's a long waitlist for new users. But Masterworks is letting you skip that waitlist just by clicking the special link in the description.
China's foreign policy has taken an aggressive turn this year.
It says its military will not sit idly by if Washington's #3 official visits the island.
China is the bank, Africa is the customer, and Foreign Minister Wang Yi is the caller.
One is one of the only major governments that has yet to condemn Russia for its invasion of Ukraine.
Since it started earlier this year, China's tacit support for Russia's invasion of Ukraine has only fueled speculation over Beijing's intentions with Taiwan, raising questions about how the world might react should China launch an attack. This kind of speculation, and being on edge, has not been good for the Chinese economy, as its partners do not have full faith in China's policy, particularly towards Taiwan. For a country that is big on trade, this does not bode well. China's plan to invade Taiwan and reassert its dominance over the island nation has never been a secret. China wants to assimilate the nation into the mainland, rhetoric that sounds dangerously close to Putin's propaganda with Ukraine. Even though a full invasion is yet to happen, there is a constant threat of its possibility, and this alone keeps not just Taiwan, but the rest of the world on its toes. This is a problem because Taiwan has fostered relations with some of the biggest economies in the world. Not least among them is the United States. China's authoritarian turn under leader Xi Jinping and plummeting relations with Washington have pulled Taiwan closer to the arms of the USA. This has infuriated Beijing, spurring it to unleash more pressure on Taiwan and sending diplomatic relations on a downward spiral. This situation has become so dangerously delicate that the Quad Summit in Tokyo that was held at the end of May, United States President Joe Biden suggested that any attempt by China to invade Taiwan will result in American military action. Coming from the mouth of the leader of the free world, that is quite the threat. It serves to emphasize just how badly China's policy is antagonizing its trade partners, the effects of which reflect on China economically. The last time the US and China tussled under the Trump administration, there were a lot of economic restrictions and sanctions that heavily slowed down economic growth. This is something that China simply can't afford right now, given the fact that it's already in a precarious position. The US is not the only trade partner that China's foreign policy is antagonizing either. Other nations like the United Kingdom are also included there, hence increasing the list of potential retaliatory forces. At the G7 summit in Madrid, the UK's Foreign Secretary, Liz Truss, recently warned China, saying,
"I do think that with China extending its influence through economic coercion and building a capable military, there is a real risk that they draw the wrong idea, which results in a catastrophic miscalculation, such as invading Taiwan." And that is exactly what we saw in the case of Ukraine, a strategic miscalculation by Putin.
Using Taiwan as an example, Truss argued that NATO needed to have a global perspective that included democracies outside of its membership. To protect the Pacific, she said, "We need to anticipate dangers in the Indo-Pacific, working with friends like Japan and Australia. We must ensure that democracies like Taiwan can defend themselves. We must ensure the self-defense of democracies like Taiwan." These are all strong words from powerful nations. For a nation like China to suffer internal economic complications and external economic hostility simultaneously will be a blow. If their aggressive policies continue, China's economic collapse will be accelerated, well, at a pretty alarming rate. If President Biden's words are to be taken at face value, military action involving the United States is bound to drag the global economy with it. This is definitely something that will affect your financial plans without a doubt. And all that heavily weighs on China's actions.
看到没？大伙看到没？各界媒体啊，中央的爷爷奶奶们，你们看一看，都有暴力机关，那些警察把我们合理维权的嘱咐。 这些人，你看他们，这还是中国的天吗？这还是中国吗？救救这些老百姓，救救这些储户吧！
Adding fuel to the China economic fire are the small local banks in the Henan region of China. As I've already discussed extensively in my previous videos, Chinese banks are in a delicate position. Citizens are starting to lose trust in the banking infrastructure and the CCP's ability to protect them from a scam. You see, China is unique in a sense that it has a lot of people. So even though a small percent of its population live in rural areas, it still amounts to hundreds of millions of people. To serve these sectors of the population, China has over 4,000 independent banks in rural areas. One of the big problems with having such a fragmented banking system is that these banks are highly susceptible to bankruptcy if anything goes wrong. In order to fight for survival, rural banks will try to skirt banking laws by accepting deposits online, by offering relatively high interest rates when compared to big banks. High rates worked, and bank deposits grew at an exponential rate. The only problem here is that these banks were lying to their customers. Customers were led to believe that they were getting a 4% interest rate from a regular savings account. Not bad. But in reality, they were depositing their money in investment products. Big difference here is that money in savings accounts is safe and guaranteed by the CCP in case a bank goes down, while money in investment products carry risk and is in no way guaranteed by the CCP in the event of a bank run. On top of all this lying, these 4 banks were not acting in accordance with how a bank should act. They were letting one of their investors have full access to depositors' money, and the investing company had complete reign over how to use that money. So the worst happened, and one of the chairmen of the investing company ran away with $6 billion of depositors' money. Depositors only caught on to this because when they went to withdraw their money, the banks would just give them the runaround. This seemed extremely fishy, so some depositors traveled across provinces to go to the bank's office, only to find out that their money wasn't there. This is when they organized their protests to bring attention to the incompetence of regulators. How can banking officials let banks get away with false advertising? How is there no oversight over how banks are using depositors' funds? Where did our $6 billion go? As the protests picked up steam, the risk of bank runs spread all over China. More news that is also coming out of this situation is that this might not be unique to these 4 banks. This could be the norm in most rural banks in China. When you couple this with the mortgage boycotts that we discussed earlier, China's banks are very close to a liquidity crisis. If trust between the citizens and the banks is not restored soon, it could push China's financial sector down a dangerous spiral. I hope you guys found this news useful. If you disagree with YouTube's judgment about considering these videos controversial, please hit that like button below. It will help my videos reach more people and let YouTube know that they might be wrong about demonetizing videos about China. And since YouTube has been demonetizing our videos, we've launched membership and a Patreon, where you can watch these videos uncensored and support the channel. Lastly, if you want to learn more details about China's banking issues, you can watch the video here.